All right. How's it going out there, folks? Hope everyone's had a good day. I know it was pretty eventful out there. So I'm sure there was some pain for folks and we may have a little more turbulence coming up here with Fed Day and Apple earnings and everything else. I mean, tomorrow's economic calendar is pretty intense. I posted a tweet about that earlier, just sort of showing how big of a day we have tomorrow. It's one of the busiest days I recall in a long while. So, certainly want to buckle your seatbelts, kind of get ready for whatever that's going to bring. I think at the very least, we don't have a particularly well hedged market into what could be a day full of some resetting of expectations about the Fed. I mean, that's the main stage event, right? We do have some other areas to pay attention to. I'm just going to rattle off the calendar because it's so much stuff going on. You've got 7 a.m. mortgage rates, applications, and refinancing, 8:15 a.m. ADP employment, 8:30 a.m. the Treasury refunding announcement, 9:45 a.m. S&P Global Manufacturing PMI, 10 a.m. ISM Manufacturing PMI, 10:30 a.m. EIA crude oil and gasoline stocks, 2 p.m. the Federal Reserve interest rate decision, and 2:30 p.m. the press conference. That's a jam-packed day, isn't it? There's a lot going on in that in that whole series of events, and yet we don't have a particularly well hedged market into that environment, which is just has me just a little bit concerned, only because if folks get caught on the wrong side of too much downside momentum, they're likely to be motivated sellers. So for me, it just has me kind of going into that being really aware of larger than normal left tail risk. So let's just look at a quick chart of skew. I'm just going to put this on screen. It's not necessarily going to scale too pretty here, but this is skew right here. It actually fell today. This is the premium on S&P index options on the put side in excess of calls. And you can see that it's not really that elevated versus positioning. Positioning per a number of different models. We're looking at CTAs or systematic managers, vol funds, all that positioning is very extended, as are leveraged funds and a number of different classes of asset managers like hedge funds have record gross leverage and very high multi-year levels of net leverage. So, you would expect to see a greater appreciation of the event risk this week with all the earnings. After hours earnings were not too well received. So that was one thing, right? That I think we kind of need to be attentive of as well. I actually shared a chart earlier of how this earnings season misses are being, well, they're not being rewarded. Let's put it that way. It's down about 4.5% on average. So pretty harsh punishment for companies that aren't making it. But this is also just telling us we're in an environment where going into this, things were priced to perfection, and there is some room for that to settle out if we don't see companies actually delivering. I know for a while folks have said, oh, fundamentals don't matter, the macro doesn't matter, we can ignore all this stuff, just look at charts, and it's fine. Look, technical analysis is great. I use it all the time. I also joke and I call it astrology for gamblers. There is science behind some of the technical analysis, particularly if you're backtesting indicators and you're finding strategies that work in the regime you're in, the assets that you're trading. But on the other side of it, there are larger prevailing forces that can reset charts, and things like earnings, as well as larger macro trends that can take a long time to play out, certainly longer than the folks that are looking for things to happen within 5 minutes. And then if it doesn't, they don't think it's real. The reality is these things play out over longer time horizons. The other reality, quite frankly, is that a lot of macro is bullish. I know I've heard from far too many people that like everyone who talks about macro is bearish. It's not true at all. There's actually enormous amounts of bullish macro data. But anyway, this is all about charts, and this is about tomorrow and kind of what we can go into and expecting with the Fed and with all the other moving parts we have. So let's look on screen at the S&P 500 first. We can get into a little bit of Fed chatter as we get into this chart and some of the others, but we could see today we kind of based at one of these more important areas of potential support around 50-50-25. I look at the market as both an auction, but also price action. It's almost like a price auction, if you will. And what I mean is you have key areas where people want to transact, and what happens in terms of the price action and how that resolves really depends on demand versus supply. So when we look at a chart like this, we get some ideas as to where we may see important transacting taking place, which is why I've created these lines. And if this is helpful to you in your process, you're welcome to take a screenshot of this chart, save it for later. These are levels that I would consider valid for the week and maybe longer depending on kind of where things end up. But I update this and we can see that the market kind of behaves pretty well based on this. This green line, this green area here, I should say, is 51.4550. That's my pivot to get bullish on the S&P. And you can see we almost put our head above it briefly today. We just kind of peaked above it and then we fell. Now, that's a pretty bearish look for me. When you look above a key pivot like that and roll over, that's usually a sign that there's some room for continuation. And that was pretty aggressive selling into the close, and it wasn't really hedging. I was thinking earlier, hey, maybe this is hedging flow. We certainly saw a lot of transacting in puts, but with skew not rising as much as it should have and open interest not rising as much as it should have in S&P puts, it looks like a lot of that activity was much shorter dated options, and those gains were realized. So that has me kind of going into tomorrow wondering, okay, what is really the setup that we have here? And I think it has to do with all of these different events. You know, I think the key events are really going to be the Treasury refunding announcement. Where do we see the most refinancing and new financing? Obviously, bills are going to be the biggest part, but do we see Yellen continue to lean aggressively into bills like she has? Or do we start to see some longer duration financing? Because this time around, the financing requirements are on the rise again. This is something that also can be revised again higher later during the quarter. This is also a government that doesn't have a budget for 2024, so we don't know what to expect. It's all a continuing resolution, and there's a bunch of pre-authorized spending from the Inflation Reduction Act and the CHIPS and Science Act. So needless to say, whatever we get in terms of the distribution of duration, it can still change later in the quarter. But I'm very interested to see that distribution. Do we see more belly of the beast and long end of the yield curve duration issuance? And if so, does that start to push up those term premiums? Because one of the things we see when we go out on the yield curve is, you know, I can get a 30-year bill, a 30-day bill, right? Just 30 days of exposure to treasuries at a higher interest rate than a 30-year bond, which means there's no term premium whatsoever in many parts of the longer end of the yield curve, which it should rise. I mean, if you want people to take risk, they need to be paid commensurate with the risk they're taking plus a premium. And we don't really see that on the long end, which makes it less tempting to want to allocate there. So I do think that's another factor that we have to weigh as we get that, further TRA announcement tomorrow. So we got the QRA. It wasn't necessarily too well received. It was larger than expected, but now we're going to get the TRA. That's going to tell us where this debt issuance is going to happen insofar as the tenors of the instruments involved. The other one, of course, that's going to be really important is the Fed. And I think it will be just as much their statement, but even more so the press conference, because we're hearing more from not only Fed speakers, but Powell himself, that he's had a bit of a hawkish pivot. I remember Powell does pivot. He is kind of, I would say, almost a little bit too flexible, kind of goes with the way the wind is blowing a little bit. And so we've seen him kind of go from mission accomplished in November to lately walking that back and saying, well, you know what, we might have to hold rates higher and we're prepared to hike if we have to. Now, I don't think a hike is terribly likely, and I don't think there's any rate change tomorrow. And I don't even think we get any change in the pace of quantitative tightening tomorrow either. But I do think that we're going to hear more things that sound like a Fed that's a little bit uncertain, a little bit more needing to lean into the data again and say, you know what, we need to see more progress before we really get confident about cutting. And so I think, the most likely scenario is if we're going to get a cut, probably comes in September. But going into tomorrow, if Powell comes out more hawkish than expected, if the QRA comes out with more longer end issuance as well, that would be an additional tail risk. I think we do have some room to push a bit lower here because, you know, we haven't yet really exhausted the lopsided long positioning, and this is healthy. You need to have a reset. You need to get the weak hands out of the market if you want the market to grind higher. And this has been a very, very easy market. And so it's become lopsided to the long side. And unfortunately, that makes it harder for it to keep climbing, right? You can't necessarily have everyone all in on longs and have the market keep climbing. You got to have these resets. You got to shake people out. And, you know, as the case may be, they end up buying at higher prices. Well, I think that's kind of what we're dealing with right now. So if we look at this chart, we are in the volume weighted Ichimoku cloud, hovering just above key support around 50-50-25 on ES. That's the June front month contract for the S&P 500 futures. And I would say that by, you know, the close of tomorrow, we could see this thing trade a bit lower. I would be looking at 50-14-50 or 49-70-50 as downsides if we get a more hawkish Fed, and if, in particular, we get a more hawkish Fed in combination with a QRA that shows some degree of longer tenor issuance. Now, on the upside, let's say we get a more dovish Fed, and let's say we get a QRA that has a lot more bill issuance than people are expecting, and it's still very, very lopsided in the short-term issuance. I don't see any reason that we can't undo a lot of the damage from today. I think we can get right back up to that pivot level of 51.45 pretty quickly. I know that sounds like a big move, but quite frankly, it would be a huge sigh of relief for the market if it got that kind of, you know, all clear. Like, you know, people are obviously pretty nervous going into this in terms of them being willing to just sell long positioning rather than hedging. That to me is actually a sign of greater concern, and maybe they're looking for a better dip to buy. But I think there is also that upside scenario that, you know, if things come in more dovish than expected, if Powell seems somehow sanguine about everything and Yellen puts a lot more of the issuance on the short end, we could get a ripper. I just don't think that's the most likely scenario. I think it's more likely we get a down 1% day than an up 2% day, kind of looking at the way everything has been trading. I also think that it's important to look at the NASDAQ here for context, because the NASDAQ actually from a technical basis is starting to look a little bit worse again than the S&P. So we had closed back up in the volume weighted cloud. So when you're in the cloud, you're not in any kind of trend. You're not in an uptrend. You're not in a downtrend. You're in a neutral state, right? So if you subscribe to auction theory, that's sort of like a market that doesn't have either party in decisive control. Okay. And you can kind of think about the cloud also as a place where kind of everyone's very close to where their aggregate positioning is, where they entered positions. So people are going to be a little more nervous, right? Positions are going to turn over a little bit more. And then eventually one side takes control, you know, and we just saw the sellers take pretty good control of the NASDAQ again today because they pushed us right back out of the cloud. And just like with the S&P, we had this small head fake above my pivot, but we couldn't hold it. And so that was another sell signal. You know, you come right back up, you kiss that key level of resistance, and then you reverse lower. And now we're starting to base closer to some support that's below us around 17,437.25 with the NASDAQ 100 futures contract for June trading at 17,508.25 after hours here. So again, this is one where I do think the path of least resistance is lower tomorrow, but it does depend on these event volatility catalysts. I could see us getting down, maybe giving back another couple hundred points, getting down to 17,229.50 if we get a more hawkish Fed, or maybe even 17,120 if it's a more brutal washout. But on the other side of it, again, I don't see any reason we can't get back up to that pivot at 17,910 if we get that more dovish Fed and that easier, more bill-heavy TRA. So it's really going to matter how things play out, what kind of liquidity effects the market anticipates these events are going to have. That would be the biggest thing that I'd have an eye on. And so the other thing that I would really watch closely here is going to be the 10-year note futures, because it's kind of like an interest rate benchmark for a lot of the world. And I'm sorry, I put up the leveraged contract. Let's put up the non-leveraged contract here. That is ZN, right? And what do we see with ZN here? I'm putting the arrows up on the chart here because this has just been kind of how I've tracked it. This is sort of what I expected. And we're pretty close. we've had this sort of reflexive move down to support. We didn't get quite there and kiss it, but then we started to move back up to resistance. Now we're starting to drop again. I do think if we cut below that key 107.01 level, we can get down to 105.13. And that is, where we're going to get back to 5% on the 10-year. So that's no joke. That's a level that's really going to ruffle the feathers of a lot of longer duration risk and really the market as a whole. So, obviously it's something that we wouldn't necessarily look forward to, especially if we're bullish on tech and growth and, things like that. But there are areas of the market that do better with higher rates and higher levels of inflation. And I would be looking at energy and materials, metals and mining, industrials, and then I would be looking at aerospace and defense for an entirely different reason. It's a defensive area, but it's also one that tends to do well because governments around the world just keep pouring money into it. So, even if there is bloodshed at the surface level, even if the indices are going down like they did for most of 2022, there's always an opportunity somewhere. There's always part of the market that is still getting bid. Looking for that relative strength is really important. So let's take a look at oil real quick because we mentioned energy. So here's a chart of crude oil on screen, right? This is, it's looking pretty weak. I could see this getting back down to 80.56 or even the bottom of this trend channel. In either of those scenarios, I would still want to rebid at either one of those levels, right? And eventually you're going to have a convergence of the trend line and that area right here, right? So we're pretty close to that as well. So for crude, I'm pretty interested in a rebid not too far lower from here. If we do break below this trend and this trend line and build acceptance into the cloud, then I'm no longer going to be interested. I'm going to have to kind of see how things go. But for now, it's served people well to kind of bid the lower end of this trend channel, right? Kind of started here. This is where we started drawing the trend channel right at that wick down. And ever since then, all these other little kind of sell-offs have been areas of opportunity to buy into crude. So my question would be like, what makes this time different, right? Is this going to be something where, we break lower? I'm not so sure. I think that the idea that geopolitical tensions are all but alleviated may be a little bit optimistic. Also, the idea that oil demand is not going to remain a little bit higher may also be a little idealistic because supply is certainly still constrained overall. So we've had 4 rebids here. It kind of built the trend line. And at the top of the trend channel, it's also been a decent place to sell a lot of the time, right? You can see that was the first area that kind of helped us to start building the channel. Then we had the second knock that helped to really define the channel. Then we had this large area where we kind of broke above, got a little too excited and rolled over pretty meaningfully. So that's why I'm kind of thinking because of this pattern, I'm still inclined to rebid crude if we do move lower, only because I feel like it's part of a pattern that's still intact. And I don't really see any negative catalysts that are imminent that tell me, okay, you need to really be careful here. Like instead, I see some potential upside catalyst still on the horizon. Like, the peak of travel season is still ahead of us. That could still bring about more demand in crude. Also, they still need to, at some point, maybe someday, refill the Strategic Petroleum Reserve. You have a lot of infrastructure spending that's still going on in multiple parts of the world, and that involves a lot of crude. You also have a lot more mining that has to be done for copper and other metals as we have more industrial build out, more transmission capacity for electricity, more unelectrified areas becoming electrified. There's just so many reasons to kind of think, oil could remain buoyant unless we really see the global economy slip. So for now, I'm still bullish of crude, but I'm looking for that rebid around 80.56. Now, gold is a little bit of a different story. I know a lot of folks have been talking about gold. I've liked it up until it broke below this trend line. At this point, I'm a little more concerned about gold longs. I'm not too bearish until we break below 22.86. Then I think we can get a good $94 downside to 21.90 because this build up here happened so quickly, and there wasn't really any support built. So it's really back all the way down here where that consolidation took place that I'd be interested in that rebid. But we have to break below 22.86 and build acceptance before I'd be looking at that. And I think if we do get a rebid there, then we're probably off, back to some level of nearing the recent highs. Like, I don't know that necessarily the run in gold is over. I'll also tell you something that's kind of funny. As someone who's been trading gold for a long time, about 18 years, gold hates Fed week a lot of the time. Not always, but a lot of the time, gold hates Fed week. And so, you do see sell-offs on Fed week very common in gold. Unless the Fed comes in more dovish, that can be, pretty bullish for gold. But overall, most of the time, gold is kind of doesn't do too well, let's say. Let's look at silver too. Silver is one that I think is at a very critical area here. So it's actually starting to build some acceptance here below this trend line. That has me looking at this as, okay, you have like until regular trading hours to kind of get back in here, maybe an hour or two in trading. Otherwise, this is going to look like a breakdown. So the only scenario with silver that would make me bullish is if this ends up being a head fake and we kind of look below and then we just pop right back into the trend channel. Otherwise, I'm looking at this chart and saying, boy, I think it's time to cut out of silver for a bit because, the more we build below this trend line, the more likely it becomes that instead we come down here and test this lower area, this 25, 23 level. So with silver, I think caution is warranted. We need to see it come back into the trend line before it can be rebid. And copper is looking a bit extended to me. So this is from my chart earlier today. This channel has been pretty well respected overall. We can see the top of the channel was kind of built out here. We've moved up at this steady angular ascent. And every retest to the bottom of the channel that we've had, has been well respected. We had another one down here, so these have all been well respected. So I think that this look above from the channel and then fake out breaking back down sets us up to test 445 and then possibly move lower here to the bottom channel. I would be loving that move to the lower channel because I'm still intermediate and long-term bullish of copper. So I'd look at that as an opportunity to rebid with pretty well-defined risk to reward, cutting my losses below that trend channel if it should happen. But that's kind of what I'm looking at on some of these key charts. There's just so many moving parts going on out there in the market. And I feel like right now, there's just a lot for us to kind of be aware of, especially on a day like tomorrow. So someone asked in the YouTube channel, when is the Treasury announcement? Scheduled for 8:30 a.m. tomorrow. But, we'll look at that for any time between that time and maybe a few minutes earlier or later, because these things can be a little wishy-washy sometimes. But it's about 8:30 a.m. Eastern tomorrow. So overall, I think that, this week is going to be really important for deciding whether or not we start to actually break into a deeper corrective state or if we start to pull out of this. One other that I wanted to look at is the Russell. Russell also basing around a pretty key area of support here. This is going to be decisive. I mean, again, a lot of the moves from today could be reversed tomorrow if we get a more dovish Fed, but I think it's more likely we get the opposite. So that's kind of what I'm looking for. That's the kind of basic setup going into it. I would be kind of careful about being too, bullish and gung-ho buying dips in this environment. We're deep in negative gamma territory. We're in the buyback blackout. We've got a lot of a different event volatility catalysts on the horizon. So I think that, dip buying in places where there's structural uptrends and relative strength, like in some of the sectors we've been talking about, that's okay. I'm still buying dips in energy. I actually found a lot of good opportunities today that I liked. But if we look at, the kind of favorites in the space, the mega caps, and even more scary, the mid cap growth and biotechs and some of these other things that are rate sensitive, I would be careful, because if inflation keeps pushing higher and the Fed doesn't say they're going to cut and all these things kind of start pushing the other way, then this rally that was predicated on disinflation, and Fed cuts and sort of a rekindling of that early cycle environment, a lot of the beneficiaries of this could kind of come under greater pressure. So, it's not about like getting short of everything to zero. Like I think a lot of the times when anyone says anything vaguely like oriented about managing risk, it's assumed that there's some kind of bearer and they're going to, short the market to zero, or that's what they want. But the reality is more like, as an investor and a trader, your first priority is always going to be risk management. If you're not managing risk first, you probably won't have anything to manage for long. So it's more about just being cognizant that we're in a higher risk environment, and that means there's greater opportunity for volatility. So we need to be aware of that in our position sizing if we're trading, what kind of inventory we're taking on, at what levels, what kind of risk management we're using with that. But we also need to be careful about how we're expressing those views. What kind of assets are we using? Are they liquid enough? Can we get in and out? Do we understand their behavior during this type of market regime? Tomorrow is a day that a lot of experienced traders sit out of equity trading, at least, because it can be very volatile. I think it's a great day to sit back and kind of learn more about what's driving all this, which, again, the big picture has a big role to play. I know folks, repeatedly like to say, oh, the macro doesn't matter. Don't worry about economic data. Don't worry about interest rates. Don't worry about the Fed. Ignore everything. That's fine if that works for you somehow. But the reality is that it does matter, and it plays out over longer time horizons, and it can be both bullish and bearish. And it's always mattered. And it's mattered in a lot of different ways. And it generally is the folks that just don't want to spend the time learning how it affects the market that just assume that it has no impact. But last year, the government fought the Fed and the government won. That's macro. That's one of the reasons the economy didn't go into recession. That's one of the reasons the market kept getting bid. It wasn't some stealth QE program from the Fed. The Fed is not all powerful, all knowing, all seeing. It is not able to control all markets all the time. In fact, last year proved the Fed can be fought. And, if the force fighting the Fed is big enough, they'll win. And, I'll just go ahead and posit this one theory I've been talking about quite a bit lately, which is that, if the Fed was able to be fought successfully by the government and their interest rate policy wasn't able to subdue inflation and slow the economy commensurate with goals, then what really makes us think that the Fed is going to be able to, cut rates and have the market follow along? Well, why would we assume that that's going to be the case? What if it's not? What if it's an entirely different outcome? What if the Fed cuts rates and the market doesn't come along because it doesn't believe that it's appropriate to be buying U.S. sovereign duration when there's no term premium on the long end, and it just wants to push rates higher on the long end, even if they taper QT? There's a lot of possibilities that can play out if inflation remains elevated. And that's the key if. If inflation remains elevated, the market can also fight the Fed and win, because the Fed is not the market. The Fed is a big part of the market, but it's not nearly the whole Treasury market. It's not even like a fifth of the Treasury market. So if you consider it from that perspective, it's really important to understand what other market participants want, what they're willing to pay for, how they express that view. And so that's why I would say, be careful thinking that if the Fed kind of lost the fight in 2023, that it's going to be any more successful in this rate cutting influencing the market, right? They couldn't really influence the market last year because the government interfered with lots of late cycle fiscal excess. That's why inflation's back. That's why the Fed has to be more careful. And that's why we have every reason to be a little more skeptical about just how much the Fed is the Wizard of Oz behind the curtain. Maybe it's not as much as we thought, right? Maybe last year was a great case study about how the Fed doesn't have as much influence over the economy and the market as we once believed. Maybe it's time to kind of walk that idea back and start to consider that really the market is the prevailing force here. And when it's being fed, as it was last year with tons and tons of fiscal excess, it's going to go higher, right? Like if the government does a lot of deficit spending and it's during a decent economic environment, where's that money going to go? It's going to go right into bank reserves. Those bank reserves are going to pump right into the market and eventually back into parts of the economy. So it sterilizes QT. It sterilizes higher rates, just like the cessation of debt issuance for the first half of last year. Let's not pretend for a moment that that was some kind of happy little coincidence that no one could come to an agreement until the very last minute. That was all by design because that also sterilized QT and rate hikes, right? If you're not issuing debt, then you're not taking liquidity out of the system. And so even though the Fed is, it's at a much slower pace than what would otherwise happen if the Treasury was running in a normal issuance schedule. So that whole idea that like, oh, the Fed's doing stealth QE or the Fed doesn't matter. No, the Fed matters, but the government can overwhelm them and so can the market. And that's the point. So on the one hand, the government can say, oh, well, we don't want you to tighten. We don't want the economy to slow. It's unpopular with voters. And so we're going to fight you and we're going to win. On the other hand, the market can say, we don't believe that, 4.6% on a 10-year is a fair rate. So you might be tapering QT and cutting rates later this year. We still think the 10-year is a 5 or 6% interest rate, right? That's maybe where we think it's a fair buy. Well, that would be essentially fighting the Fed. And that can happen all the way down to the bills on the yield curve as well. They could push up higher as well. The Fed doesn't necessarily control these markets. That's the point. They influence them. They do. They have a very palpable influence, but they do not control them. And last year proved that in one way, and how things go from here may end up proving it in another way. That's something that I just kind of wanted to talk a little bit about as well, just because I don't think that this is discussion that's happening much on financial media, on social media, or elsewhere. I'm not seeing it in bank research notes much, but it's happened before. It can happen again. I mean, if you go to back in time, the great financial crisis when the Fed was doing QE and different variations of yield curve manipulation and otherwise, it didn't always play out like they wanted it to. The Fed was one participant in a very big market. We have to keep that in context because COVID reset our expectations as they took out a bazooka and just shot liquidity indiscriminately into almost everything that wasn't nailed down or on fire. We're not likely to see that again anytime too soon without a real crisis, and certainly not with inflation this elevated. So that means that the market can fight the Fed. The market can, kind of push against policy if it doesn't believe that these are the areas where it wants to be bidding on U.S. paper. So I would just keep that in mind, as we get closer to those cuts that could happen. Maybe we'll get one or two. Maybe we'll get the first one in September. That would be my baseline. I would also say I think any cuts are a mistake. I think it's a policy mistake for the Fed to cut interest rates. I think if they cut interest rates, it will reinvigorate inflation further. The Fed, they have a pretty simple dual mandate. It's price stability and maximum employment. And I don't think we've had price stability. I mean, let's see. Can we pull up CPI on here? I think we can. Yeah, there we go. And cool, this is cumulative CPI. This is the chart they don't show you very much because it's kind of annoying. It kind of discounts the idea that like inflation is under control. This is the index over time, and this is already an understated index. Like it's already grossly deflated because of how it's measured and how it's rebalanced. But look, tell me that inflation is under control. Now, this is something that I think deserves some additional attention and education. Many people in the market understand that the way we measure inflation is the rate of change. We don't measure it on the basis of cumulative inflation, right? So most people don't look at the CPI index this way. They don't look at it in cumulative terms. But I think it's a really good exercise because what it tells us is the purchasing power of our currency is shot. And a lot of this has to do with fiscal and monetary largesse. Look at this chart since like the 70s till now, right? The purchasing power of the dollar is down 90%. It's crazy. And this is what doesn't get discussed much because they'll say, oh, but we're looking at month over month and year over year. And the rate of change. What was it last month? What was it last year? But, if you buy things, it doesn't really matter what the month over month or year over year rate of change is. It matters what your bill is when you leave the store. That's the only thing you care about, and that's the cumulative inflation. It's not the rate of change that you're going to care about when you're, buying $150 worth of groceries and it used to be $90. You're not going to care about the rate of change when, you see the price of houses and everything else going up no matter what. The rate of change is inconvenient when it's much quicker. But the problem with focusing on the rate of change is it misses a really big element of it. Even if the rate of change comes down and we go to disinflation, prices are still rising, just at a slower rate. So even if the Fed gets inflation down to their mythical 2% target, that doesn't mean prices are going to drop 1 penny. It means they go up at a slower pace. That's the ugly truth about inflation. That's the part that doesn't get talked about enough. I'm saying the quiet part out loud. So there's a bunch of economists out there somewhere face palming right now because you're not supposed to do that. But that's okay because the chart speaks for itself. This is a chart you can find on Fred. You can find it on TradingView, stock charts. This is the cumulative index of prices. So I would just say, inflation's not under control. It hasn't been for a while, and it's starting to accelerate from an already elevated base of cumulative pricing. And I think that should matter to the Fed. I think that should matter to policymakers, and I think that should matter to us as people who have to buy things and services in this economy, and they're appreciating in value. And what's really happening is our dollar is losing value. I was asked, how do I think semis will behave? Well, I think it has everything to do with what happens with tomorrow. I mean, tomorrow is a pretty big day. So I think semis are going to be sort of a derivative of how the NASDAQ behaves and how NVIDIA behaves. The SMH ETF is 20% NVIDIA and 10% Taiwan Semi. So it's basically the NVIDIA Taiwan Semi ETF. So those two stocks will also help to determine how semis behave. But I would say if we get a more dovish than expected Fed, more bill issuance on the TRA, then semis could be bid pretty nicely, So if we look at SMH, I'm probably going to have to zoom this in quite a bit because it's a month-over-month chart, so bear with me. There we go, and we'll just maybe take this in a little bit more. Yeah, so semis, they're in the cloud. They've broken down below their uptrend line. They tried to push back above recently. It was a valiant effort. Got right to the top of the cloud, rejected, and now below that uptrend line. So you could stay from the uptrend line, we're no longer in an uptrend, and from the cloud, we are trendless, right? So I'm hesitating on saying that we're in a downtrend yet. One day doesn't necessarily reset a whole trend, but I think tomorrow will be pretty pivotal for the semiconductors. We're in a very important area. So if we get a more dovish Fed, maybe we can finally break out to the upside away from the cloud and towards some of these recent highs where there's some supply that we might get some resistance at. On the other side of it, though, if the Fed comes in more hawkish than expected, which is very possible and kind of my baseline, I think we could get back to the base of the cloud here. So I think it's a two-sided scenario, and the biggest event volatility catalyst is the Fed, followed by the Treasury and where the distribution of tenors is for their debt issuance. So let me know if that helps. Let's go over Tesla real quick because I did share a trade idea today about Tesla. I just basically said I think that the opportunity to fade it here is back on the table. And we can certainly see with how it's been trading that the market seems to kind of agree with that assessment, right? We've got this rejection of this trend line, and we can see every time it's rejected this trend line lower, we've had this sell down. And so for me, what I'm really looking for is quite simple. I'm just looking for a continuation of that pattern. I'm not even greedy on this. I'm really just looking for 157.45. Some people would say, "Oh, we could go back to the lows. We can make new lows." That's totally possible. It's in a horrible downtrend. It's been in a horrible downtrend for a long time. I mean, you zoom this chart out, and you can see this thing has been just getting absolutely crushed since its peak in 2021, right? So maybe you could argue that now it's sort of in a state of consolidation, but overall, Tesla investors can't be terribly happy if they only got in a couple of years ago. And I think the way it's trading right now is we had this reflexive relief rally post earnings. Skew had been completely blown out to the bearish side. Now we've reversed that. Skew is very bullish. And I think that this is a great time to kind of rug the other side. The shorts were rugged. Now the bulls can be rugged in Tesla as well. And it looks like the beginning of that was today, where they made an announcement that they were gutting their supercharger team, and that there are some other firings that are coming down the line in Tesla. And this actually caused Elon Musk to unfollow some influencers on Twitter because they broke this news before, I guess, Tesla was able to try to control the narrative. Maybe he was hoping for a little more follow through in the stock. But at the end of the day, unfortunately, this is something that, it's really just a car company. You look at the revenue breakdown, and it's hard to argue that that's not the case, right? Let's see if I can find it. All right, here we go. I found it. Now let's see if it'll open for me. All right, there it is. So here's a diagram of Tesla's revenue, their income statement, right? This is auto sales. So if auto sales is the vast majority of everything that comes into this company, then it's a car company. Like that's like, to me, that's the baseline. I know they have all these exciting plans. Like, we're going to build robots. We're going to have self-driving. We're going to have Airbnbs on wheels. We're going to have sort of everything you can possibly imagine and we're going to have AWS built out of a bunch of different cars wirelessly networked to each other. Like, seriously, they've said all this stuff in the conference call. It was a total circus. They also said that other major car makers will buy their self-driving tech, but also went on to say their self-driving tech is very simple. Which doesn't really make a good case for selling it. But anyway, this is a car company. Like, that's hard to argue with when you just break it down by the income. Now, if they start selling robots and they start making self-driving, and, solar finally takes off, and they have all these other initiatives that start making revenue streams look a lot different than it does now, then I'm willing to, update my view as the data updates. I'm not stuck in a view. Okay, it's very important as investors and traders not to get married to a view. So I'm not married to the view that Tesla is a car company. I'm not saying it's always going to be a car company, but right now it's a car company. So that's my 2 cents on Tesla. You don't have to agree with it, but I am looking for prices to move lower, and my near-term downside objective would be 157.45, and if price moves above 196.35, then I'm going to admit I'm wrong, and I'm not going to want to keep that trade on. So that's kind of how I'm looking at Tesla right now. So I've been asked if I can look at the Nifty 50. Sure, I can look at the Nifty 50. So here we go. Let me just take a moment to kind of parse this and see what all we have here. So overall, I am still constructive on India. In fact, at Macrovisor, India has been one of our favorite emerging market picks for quite a long time now, over a year. And we're still bullish. In fact, my partner, Aisha, put out a really good article. It's free on our website at macrovisor.com. So check out www.macrovisor.com for the free article on India. Just recommend that for folks out there that are curious. It's really good to get out of your wheelhouse, by the way. If you're just always investing in, US stocks, and you're always kind of focused in one area of the market, or you're just not really, navigating different sectors or different regions or different asset classes, it really does help to just kind of work your way around. Find other opportunities elsewhere. It's not like all the opportunity isn't always going to be in the US. We've been really spoiled. If you're a US centric investor, we've been really spoiled for a long time, and it's been great. It's been great. I'm not going to lie. But I think it makes sense to look at all these other areas in the market as well. So what I'm seeing with the Nifty 50 here is just that we do have this resistance area that we are having trouble getting up over. So I do want to see it be able to get above 22,675.65. At that point, I think we have kind of blue skies here to keep moving higher. On the other side of this, though, if we do get rejected here, the first area that I'd be looking for is kind of just a top of the cloud bounce, which gets us right into this point of control, right? So the point of control here is where there's been the most transacting, buying and selling. It's an area where the market gets kind of stuck. You can see how it's traded here. It's been a pretty popular kind of part of the consolidation zone over the last several months. So we could definitely retrace back to there. If we did, then we'd be sort of in the cloud, right? If we don't just bounce off the top of the cloud, we get stuck at the point of control, we could kind of get into a state of consolidation for some time. And then we'll probably have to reevaluate the near-term bullishness on this market. But for right now, overall, it looks constructive, but it does have that resistance overhead at 22,675.65. I want to see a determined push and close above there, and then I think we'd have some more room to run. Until then, if I hadn't bought this, if I wasn't already long INDA, that's how I'm trading it here in the US, then I wouldn't buy it right now. I would still look for this confirmation. So let me know if that helps with the Nifty 50. And folks, if you have any questions, if you're tuned in, more than welcome to come on by, pop a question in the chat. I'll be around for probably another 10 minutes. Let's take a look at the Nikkei, since, Japan's been a topic of conversation. It has pulled back recently. I want to say, but I'm going to draw a crayon line just to confirm, but I want to say it's still overall like somewhat trend healthy. Let's see here. Yeah, I mean, it's not bad. It's not great, but it's kind of just trying to hug this this crayon line that I've drawn here that's not incredibly precise, so forgive me for that. It is late. But, we've had 3 touches on it. It has shown some level of support. It's cut through it, looked below, and moved back above. But we're also in the cloud. We have seen this kind of, pattern of making a lower low. We had this low here. Now we've made a lower low. So I'd argue that this is one that, from a momentum perspective, you're in a very uncertain area. The longer term trend line is intact, but you are in a period or in a situation where you've got a lot of supply overhead. You're in the clouds, so you're kind of trendless by that perspective. And, you have that kind of war going on in Japan between the yen and trying to defend it in the interest in making sure it doesn't go out of control. And on the other side, the Bank of Japan's largesse in monetizing all of the Japanese government's largesse, right? They own about 55% of the Japanese debt, and they can't stop buying or it causes other issues as well. So that was, I would say that Japan is something that I don't think it's going to be a fast motion situation anytime soon, but I think it's like a slow motion car crash. It kind of has been for decades, and it still is. Like, their market's doing remarkably well, and that's because they finally kind of figured out the secret sauce to get asset inflation and real world inflation going again. And it was just irresponsibly reckless monetary policy. But on the other side of that, I do think that they're not out of the woods. So I would be careful. Like, I was very bullish of Japan last year. If you've been following me, you recall I was long Japan and short China twice last year and beat the heck out of the U.S. markets at the index level on both the NASDAQ and the S&P for those trades, right? Each one of those was just knock it out of the park trades. I'm not bullish on Japan like I was. I'm still like constructive. I think that there's opportunity if you're really a good stock picker and you can find the high quality names. I don't want to buy the index right now. And I don't necessarily want to have any long or short yen exposure. I'd be more inclined to go short, but I still think that, this move has gotten a bit extended. So I'm not necessarily wanting to go all in on it. I was pretty darn short the yen last year. Like part of my long Japan trade was short yen because I was hedging that risk using the HEW JETF, which if you say it fast enough, it says huge. But that ETF was a good way to go long and hedge out that yen risk in an environment where otherwise you would have lost a lot of your gains because of how much the yen was depreciating versus the dollar. So, that's another thing to think about, by the way. If you do invest overseas in ETFs, you've got to remember a lot of those are not currency hedged. So that is, dare I say, one of those situations where, the macro does matter because the prevailing interest rate differentials can drive the currency. So if you're an emerging market like Thailand and their interest rate is significantly lower than the US, even if their stock market goes up 8%, if their currency goes down 8%, you're in a wash. If you're in one of those ETFs, it's not hedging out your currency risk. And I'll tell you what, there's not a lot of currency hedged ETFs for emerging markets. So you're going to be pretty limited in what you can do to manage your risk. There's even not that many for developed markets. And the ones that do exist typically aren't very liquid. So that's another thing to just keep in mind as as someone who's a participant in the markets. Like, yes, expand your horizons. And hey, it's not terrible to get exposure to other currencies, but you have to do it during the right market environment. You can't just do it whenever you want for whatever reason. What's going on in that country, its economy, its interest rates is going to matter if the other side of that is you have exposure to the dollar versus that currency, right? So just think about that. I know it's complex. There's a lot of different things that are going on. So I just think at the end of the day, we need to be a little bit more kind of global in our view. We need to be a little bit more willing to be flexible about what we buy, because I just see a lot of folks talking about like the same 50 stocks all the time, and that's fine. And if you make money, just doing that, then please, more power to you. Do what works. But if it's not working for you, or you're interested in finding uncorrelated returns outside of the US and the S&P and the NASDAQ, there's so many opportunities out there. So you don't just have like kind of one area where all your risk is focused. Diversification doesn't mean just different sectors and industries. It can also mean different regions, different asset classes. And I think that's something that is going to become more important in the years ahead. I think it's probably going to be more important to have higher levels of commodity exposure and higher levels of emerging market exposure and developed markets outside the US exposure over the next 10 years. I'm not saying the US is going to be a place you don't want to be, but I think you're going to get opportunities for better returns in some other markets as well. And there's no reason not to look there. I mean, look at India outperforming the US this year so far, for example. So I'm asked, do I think it is time to start positioning in bonds? I don't. And the reason I don't think it's time to start positioning in bonds is because there's no term premium in bonds. So like you have two choices really, when you're buying a bond. I mean, I'm going to oversimplify it, right? You obviously, there's some more to this, and maybe I'll get into that if I have time. But basically, you either buy and hold to maturity and you get 100 cents on the dollar back plus the yield the whole time, or you sell at some point and you have to realize whatever loss or gain the market gives you. And if you're buying a bond, well, in the US, a bond is technically a 20 or 30 year bond, right? Like anything shorter than that, a 10-year, a 7, a 5, a 2, those are notes. And then the 52-week and below, those are bills, right? So there's that whole differential too, just the vernacular. But if we're talking about bonds, 20s and 30s, I have zero interest. I can get better yield on a 30-day bill than I can get on a 30-year bond. So there's no term premium, even though I'm taking appreciably higher levels of risk, like 29 years and 11 months more risk. but I'm not being paid more for it. I'm being paid less for it, and I'm taking principal risk. Well, the old way that you looked at banking back in the past was the interest rate was predicated on the idea of the risk you're taking and a premium on top of that. So if you think that a 30-year bond in the US represents less than, 5% risk to you of dollar depreciation or default or other issues over that period of time, then you may have a more optimistic outlook than I do. I think the dollar will be down more than, the 5% compounded interest rate over that 30 years. Or whatever it is. It's lower than 5. It's like 4.6 and change or 4.5 and change. But anyway, I just don't like it for that reason. I also don't like it because if you're doing it like a lot of people do it, and this is the third rail, people buy TLT. Well, then you're just basically gambling because you don't have any guarantee of risk-free returns, right? The advantage of treasuries is you're supposed to be made whole by the US government when it matures. Well, these ETFs never mature. They just have a rolling exposure to paper. And so you're just going to be at the mercy of prevailing market conditions. So my opinion is the bear market in bonds is not over. It was a 40-year bull market. It was a secular bull. And now we're in a different period of time. Inflation is back. And I don't think that until it's thoroughly subdued, that it's time to get real bulled up on bonds again. The only thing that would change my mind on that would be a recession, and that would be short-term defensive exposure, not longer-term fixed income exposure. For now, I'm content to park my money in bills and some of the higher quality tax-free municipal bonds and some of the higher quality investment-grade corporate debt to generate fixed income. So, and also I do like some of the higher quality dividend stocks, especially if rates move higher. So hopefully that's helpful. So folks, I'm going to hop off here. I'll be back tomorrow. I'm going to start off early on the Traderade Discord for members. We're going to do some prep ahead of the Fed. So you're welcome to join us there. If you haven't joined the Traderade Discord, you can get 20% off on me. Just use the code Mayhem20 at checkout at traderade.com. But then I will also be back to talk about the Fed's decision and its reaction and everything. So I'll be back live publicly after we do our market prep on the Traderade Discord. So please consider joining us on Traderade. Really love to have you with the community. It's a great community. We're different than every other trading community out there. Very inclusive for people of all skill levels, all about education, helping you find your edge, not just calling shots. It's all, having discussions, trying to figure out where there's opportunity, learning how markets work. So I hope you all enjoyed this stream. Really enjoyed doing it for you. We'll talk to you soon. Good luck.